fundsupermart.com.
Hello everyone. Europe enjoyed impressive gains in the first quarter, so what is the outlook for the European market? Joining us today is Holger Wiener, Director and Senior Product Specialist of Allianz Global Investors, who share with us his views. Welcome, Holger. So what is your outlook on the European market in the second half of the year?
We actually remain quite positive for the European stock market. We've already seen a good move in the earlier part of the year, which was mainly driven by the macroeconomic environment. So you have the ECB taking action, you have the sentiment numbers improving, you have some real economic numbers now also showing improvement. Look at consumption, for example, car sales, very strong, for example. So the macroeconomic environment has improved quite well, but we think this is more or less in the price by now, as we've seen a good performance year to date. The next leg upwards should be driven by the earnings of the companies. And here we remain quite positive because we think quite a number of drivers, positive drivers for company earnings are in place. You have the exchange rate, which is good for the competitive position, translation effects, for example. You have the lower energy costs, which are good on the cost side, but also good for consumption, for example. You have the ongoing reforms, think of labor market flexibility, think of tax reforms, for example, again, should be good for margins, should be good for earnings. You have the ultra low interest rate environment. A lot of companies have been refinancing their debt at a lower interest rate, obviously. So again, this should be good for earnings. So we think this should be the driver for the rest of the year, probably even longer. We've already seen a certain sign of this in the results for the first quarter, which on average have beaten expectations. Exchange rate was one of the quoted reasons, for example, but this is something which is going to take some time, so it's only going to filter through eventually. So we expect more for the rest of the year.
Where do you think the euro is heading to, and how will this affect European equities?
Yes, we've seen recently a certain consolidation in the euro. So the movement was not with regard to depreciation, but appreciation versus the US dollar. So we've seen some 6-7% since mid of April, probably. What you have to keep in mind is on a year-on-year basis, we're still down 20%. So this is still something which is quite significant and which is important for Europe because obviously it's a very open economy. Exports are important, so a lower exchange rate is supportive for the companies. So this is still very much in place. We would think that some of the exchange rate movement which we've seen recently was driven by the interest rate differential, which has narrowed to a certain extent. So interest rates going up in Europe, closing to a certain extent the gap to US interest rates. Actually, with the Fed becoming more restrictive, we would expect higher interest rates going forward in the US. So this gap could open again because the ECB is still very much on QE that's going to be with us until September next year, for example. So there should be a certain widening of the gap again, which again would speak for depreciation of the euro against the US dollar. So the move might continue to a certain extent. On the purchasing power parity, we think 110 is actually quite justified, but markets always overshoot, so we might as well see parity, for example. You never know.
What is your view on the Brexit? Will this be a tail risk for the eurozone?
Greece has been a topic for quite some time by now. Not only Greece, there were other political or geopolitical issues which have actually overshadowed the situation in Europe. I mean, the improvement on the macroeconomic side, certain improvement at least, also the good situation on the company level has been in place for some time. This has always had a dampening effect on the European stock market, which on the one side is positive because it still shows that markets are, we do not see a bubble, an exaggeration, what's happening in Europe, but it's a healthy development, basically. There are still risks which are discounted. On the other hand, when you look at what's happening in Greece, markets are getting increasingly fed up by all these negotiations. It seems like taking one step forward and taking another step back on the next day, basically. We actually think that we are not going to see the big bang situation where Greece is leaving the eurozone. This is in nobody's interest. So we think this should be something not really on the agenda. There might be an accident where just because of the negotiation, the parties are in such positions they cannot have a face-saving solution anymore. But this is an accident, which hopefully is not going to happen. What probably is the more likely scenario, and this is what we've been looking at for all this time, is this muddling through. So we do not get this one-off solution in a positive or negative sense, but we are going to have news flow which is positive, then negative again, step forward, step backward, but it's not going to blow up. There's going to be a certain solution eventually, but it's going to take time. This means that the European market will remain overshadowed by this to a certain extent. So as in the past, it's likely that we are going to see some volatility, setbacks whenever there's political news flow, which actually we think is a good situation for our strategy, for the European equity dividend strategy, which historically was able to mitigate some of this market fluctuations.
Could you share with us your investment strategy?
Yes, our investment strategy is actually quite clearly defined. When you look at the market, dividend strategies as such, there is no clear definition. You're looking at 10 different dividend strategies, you will see 10 different approaches, basically. So what we wanted to achieve is a more transparent approach, so investors can understand what we are actually doing. So we have a buy discipline attached to the dividend yield, and we have a sell discipline attached to the dividend yield. So we want to have at least a quarter more dividend yield than the market for the stocks which we are buying, and we are selling those positions which drop on market average yield. They only do this if they outperform, the gap is closing, so we sell after good performance, obviously. We're not only buying these stocks because of the high yield, but also we think these are good or even better companies. They are disciplined by this high dividend payment. There's less scope for other activities like takeovers, which are more risky, as we all know. So these are more reliable, more stable companies, which are more prudent with their finances because they've already set aside a good part of their cash flow for the dividend payment. That's this disciplining effect which we are looking for. So first, the level of the dividend is important for us, and then we are looking at other factors like dividend growth, for example, as well. What follows from this is also a counter-cyclical strategy. We are looking at those parts of the market which have been neglected. The high dividend yield is a signal for us something might be interesting, so we have to go in and do our homework. Is this a number which is realistic? Is it a sustainable number? And if so, often the case is the market is discounting a problem which we don't agree with, or not fully at least. So we think it's a good opportunity.